Studies have shown that most active investors fail to beat passive vehicles like ETFs and index funds. This means that all your efforts researching stocks might be going to waste. Not only are you spending time, money, and putting efforts, but you're also likely taking more risks to likely earn lower returns in the end. So why not just invest in a REIT ETF like the Vanguard Real Estate ETF and be done with it? Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to explain to you why I'm not investing in the Vanguard Real Estate ETF. But before I get started, I want to let you know that we just created a new YouTube channel that will discuss all our favorite non-REIT investment opportunities. It will be run by Samuel Smith, who's VP at our company, and I will also occasionally appear on the channel, so I strongly recommend you to go subscribe to it. I'll put a link in the description of this video. So why am I not investing in REIT ETFs and the Vanguard Real Estate ETF specifically? There are 5 key reasons. The first reason is that the REIT market is today still quite inefficient. As I mentioned earlier, studies show that active managers fail to beat their benchmarks in most sectors of the market, and this is because the financial market has become very efficient with countless professional investors looking for mispriced opportunities, and as a result, when some occur, they are typically quite quickly corrected, and it's very difficult for active investors to earn enough alpha to make up for their high fees. But the same studies show that REITs are an exception. It's one of the very few sectors of the financial market in which active managers have historically been able to beat their passive benchmarks, and that's despite charging high fees and often managing lots of capital, hundreds of millions, which will reduce their flexibility and prevent them from investing in many of the smaller and lesser known REITs, which are quite often the most rewarding of the entire sector. The reason why they've been able to outperform is because the REIT sector is today still much more inefficient, and this leads to more frequent mispricings that active managers can take advantage of. It makes sense when you think of it, because REITs are today still a fairly small and obscure sector of the financial market. They are a bit of a weird category because they're essentially a hybrid between stocks and commercial real estate, and this leads to inefficiencies because real estate investors typically don't trust the stock market, and then stock market investors typically have very little knowledge about real estate, except perhaps the local housing market. As a result, there are fewer knowledgeable investors who are targeting REITs, and not surprisingly, it leads to more frequent mispricings, with REITs seeing their valuations deviate very significantly from the fair value of their own real estate. And I believe that I'm in a unique position to take advantage of these opportunities because I combine a background in private equity real estate with the education of the CFA curriculum, and that gives me a good understanding of both commercial real estate as well as the stock market. And it really makes a difference to know these small things, like the difference between a triple net lease and a double net lease, or knowing what's the capex of a specific property sector, or how much in leasing commission you'll have to pay to release an empty office building, or knowing how Class A versus Class B apartment communities are going to perform in an environment of oversupply. These small things typically are poorly understood by generalist investors who focus on all sectors of the financial market, and so having this knowledge gives me a competitive advantage. Therefore, I prefer to be active and build my own portfolio of individual REITs that I believe are opportunistic, because I expect this to lead to higher total returns over time. It has been true historically for me, with our portfolio at High Yield Landlord delivering about 50% higher total returns than the Vanguard Real Estate ETF, and I expect this outperformance to continue far into the future. By the way, if you want to access our entire portfolio, I'll put a link to a 2-week free trial in the description of this video. Then the second reason why I don't invest in REIT ETFs is because they invest in recurrent underperformers that I expect to lower their returns over the long run. The financial media often talks about commercial real estate as one whole asset class, but in reality it represents over 20 different property sectors, and there are very significant differences in the performance from one property sector to another. To give you an example, over the past 30 years, the hotel REIT sector delivered roughly 9% average annual total returns, but the self-storage property sector delivered more than double of that. But ETFs are not in the business of picking and choosing, so they will instead invest in all REITs, including the good, the average, and the bad. My portfolio today has zero exposure to offices, mortgages, hotels, and other capex-heavy sectors that are highly cyclical and facing technological threats, and I expect this to lead to higher total returns over time. Hey, before I go into the next reason why I'm not buying REIT ETFs, let me know in the comment section below what are your favorite REITs to buy today. And also, if you enjoy this content, please click the like button. That helps me a lot to grow this channel. Thank you very much in advance. Then the third issue of most REIT ETFs, including the Vanguard Real Estate ETF, is that they are market cap weighted, which will then push them to invest very heavily in the mega cap and the large cap REITs and much less so in the smaller REITs. The problem here is that this leads to a lot of demand for the shares of very large REITs irrespective of their fundamentals, and as a result they are today priced at historically large premiums relative to the smaller and lesser known REITs. Small caps are today priced at just around 10 times FFO on average, and large caps are priced at right around 17 times FFO, so that's a very large spread. To give you an example, here Avalon Bay Communities, which is one of the biggest apartment REITs, today is priced at around 18 times FFO, but its closest peer, BSR REIT, which in my opinion owns even more desirable properties that will enjoy stronger long-term organic growth prospects, is priced at just 12 times FFO, so pretty steep discount. Another great example would be Realty Income, also known as O Stock, which is one of the biggest REITs in the world and is today priced at roughly the same valuation multiple as many of its smaller peers like Agro Realty, and that's despite growing at a slower pace and having much more leverage. So in many cases it makes sense to invest in the smaller REITs because they are more opportunistic than their larger peers. The fourth reason why I think that I can do better than ETFs is that they lack exposure to special situations. Active investors can profit by investing heavily in special situations like REITs that are selling some assets or undergoing some type of strategic review to perhaps even sell the entire company at a premium to the latest share price. We have frequently profited from this type of transactions. So far this year we've profited from two Blackstone buyouts, first with Tricon Residential, then with Apartment Income REIT. Both occurred at pretty significant premiums to their latest share prices, and yet ETFs like the Vanguard Real Estate ETF typically will hold very little exposure to this type of special situations that can really move the needle in terms of your portfolio performance. And then the fifth and final reason why I'm not investing in VNQ and other ETFs is because the dividend yields are typically too low, at right around 4 to 5%. In my opinion, real estate should be an income-oriented investment first and foremost, and that's not enough for me. The yield is so low because they invest most of their capital in the larger and more expensive REITs, and then on top of that, ETFs like the VNQ will also invest in non-REIT companies like brokers and home builders, which typically don't pay any dividend. At High Yield Landlord, we aim to earn closer to a 6 to 8% dividend yield from REITs that have a safe payout ratio and strong long-term growth prospects, and we achieve this higher yield by being very selective and investing in the most undervalued companies. A good example today for more conservative investors will be WP Carry, ticker symbol WPC, which we've recently covered in a separate video. It's offering a 6.1% dividend yield, and that's despite having a strong BBB plus investment grade rating and owning mostly industrial properties with long-term leases that enjoy CPI-based rent adjustments. Then if you're willing to take a bit more risk, another REIT that's very attractive today in our opinion is called EPR Properties, ticker symbol EPR. It's offering a 8.4% dividend yield. It was just recently hiked by nearly 4%, and we expect more growth later this year or early 2025. By earning a much higher dividend yield than the ETFs, we have a significant head start that they need to make up with faster growth, and we're also less dependent on capital appreciation to earn strong total returns over time. Now, once more, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter for a 2-week free trial. I'll put a link to it in the description of this video. And then again, if you could please click the like button and subscribe to the channel, that will help me a lot to grow it. Thank you so much in advance. I'll see you at my next one. Bye bye.